does a rumored diplomatic phone call in the Middle East dictate whether you can afford, like, a premium baby stroller in a retail aisle, or, I mean, whether a Bitcoin wallet gains or loses $1 billion in a single week?
Yeah, it's wild how connected it all is.
It really is. Today, we are tracing those invisible threads connecting global geopolitics directly to your wallet. So, welcome everyone to the NovaStream 24/7 broadcast.
Thanks for joining us.
If you are tuning in right now on YouTube, you're seeing those live tickers scrolling right below us. We are tracking the live crypto markets for BTC and the major altcoins, the global financial indices, so, S&P 500, Forex pairs, and we've got that auto-curated breaking news feed moving at absolute warp speed.
It's relentless today. I mean, honestly, it is one of the most structurally complex trading days we have seen this quarter across almost every sector.
Right, and our mission right now is to just step back from that relentless feed and bring you the highlights of the day.
Sort of cut through the noise.
Precisely. We are taking today's most critical developments, so volatile crypto ETF flows, shifting oil metrics, massive retail earnings, and major political shifts, and we are synthesizing them for you. We want you to understand the interconnected forces that are driving the markets right now.
Because it's not just random numbers moving on a screen.
No, not at all. So, setting the table here, we are looking at this rip-roaring 3-year AI-powered bull market, right? This run started back in October 2023, and it has somehow survived Silicon Valley Bank, multiple tariff standoffs, but right now, it is colliding head-on with a really profound global bond sell-off.
Yeah, and to understand the live indices on your screen right now, you really have to look at the plumbing of the global economy.
Yeah.
And right now, that plumbing is the global bond market.
Okay, break that down for us.
Well, the sharp sell-off we were seeing there is entirely driven by high energy prices, which, of course, are reigniting all those inflation fears.
Right.
And the absolute epicenter of that energy anxiety is the ongoing closure of the Strait of Hormuz.
So let's actually pull up the NovaStream commodity ticker really quick, because prices are actually dropping today, despite that closure.
Yeah, it's interesting.
Right. Brent crude just fell 45 cents to $110.83 a barrel. And WTI dropped 27 cents to $103.88.
What's fascinating here is the catalyst for that drop. I mean, U.S. President Trump reaffirmed that he would end the conflict with Iran, quote, very quickly.
Right, the rhetoric has shifted.
Yeah, and following that rhetoric, Gulf allies requested a temporary pause in planned U.S. strikes, to facilitate negotiations. So basically, the market is aggressively pricing in a potential diplomatic breakthrough.
But the stakes here are just astronomical. I mean, the Strait of Hormuz carries roughly a fifth of global daily oil supplies.
Huge volume.
So any disruption heavily dictates crude pricing. But I really have to push back on the market's reaction here.
Okay, let's unpack that.
If the Strait is seeing one of its busiest days since the closure began, I mean, the physical supply route is still incredibly constrained. It feels like we are, canceling our hurricane insurance while the Category 5 storm is still hovering right off the coast.
That's a great analogy.
If the ships are still blocked, isn't the market just trading on a mirage? How much of this price drop is real relief versus just a momentary easing of the risk premium?
Well, you are hitting on the fundamental difference between physical supply and the risk premium.
Right.
The market doesn't price oil solely based on the barrels sitting in a tanker today. It prices oil based on the mathematical probability of a catastrophic supply shock tomorrow.
Okay. That makes sense.
So when the U.S. pauses strikes, the probability of regional escalation drops.
Mm-hmm.
And that insurance premium you mentioned, it just evaporates instantly.
Yeah.
However, geopolitical risk premiums are inherently fragile. The physical reality, like you said, is that the oil remains bottlenecked. If diplomatic talks stall, that premium gets priced right back in immediately, and crude spikes.
Wow. Okay. So we have this profound geopolitical friction keeping inflation fears alive globally. How is that actually playing out in the physical economy? For everyday shoppers?
It's trickling down fast.
Well, Target's entire business model relies on navigating these exact pressures.
Yeah.
And they just delivered their Q1 earnings.
And retail earnings are, frankly, the ultimate stress test for macroeconomic theory. They show us what the consumer is actually willing to absorb.
And Target just smashed that stress test. I mean, we are talking sales up 6.7% year over year to $25.44 billion.
Those are massive numbers.
Same-store sales rose 5.6%. And their adjusted earnings per share hit $1.71, which completely crushed the $1.47 estimate.
No, Wall Street loved that.
Oh, yeah. Shares are up 2.7% pre-market today, adding to a 30% gain for 2026.
But those numbers require a really deep look under the hood.
Yeah.
Because consumers are incredibly squeezed right now. Yeah. The geopolitical tension we just discussed, the Strait of Hormuz that's driving up freight costs, which drives up the cost of everyday goods on the shelves, gas, clothing, you name it.
So how are they doing this?
Well, Target's CEO, Michael Fidelk, pointed out that they are seeing remarkably consistent traffic from both high-income and low-income shoppers.
Which is wild.
It is, and the mechanics of how they are achieving this are brilliant.
It's a total paradox. On one hand, they lowered prices on, like, 3,000 spring items to help out the cash-strapped consumer.
Right.
But on the other hand, they are going incredibly upscale. Like, 200 stores just kind of these premium baby sections with a literal concierge service for parents.
Yeah, concierge in a Target.
And they are rolling out premium beauty sections in several hundred stores this fall. It's like they're offering a lifeboat for your wallet on the essentials, but simultaneously building a luxury cruise deck for the baby and beauty aisles.
It is a classic barbell strategy in retail. You take a margin hit on the essentials, the groceries, the paper towels, just to get the foot traffic in the door.
Because everyone needs toilet paper.
Right. Then, once they're in, you capture the shopper's discretionary income on high-margin items. When people are stressed about overarching inflation, buying a premium lipstick or, a high-end baby monitor, it feels like an accessible, localized luxury.
And the physical design of the stores reflects this psychology perfectly. I mean, they are doing over 100 store remodels. And Fidelk specifically mentioned the shopping cart.
Oh, this is my favorite part.
They revamped them to include space for 2 drinks and a spot to throw a toddler in for the ride. It is a genius micro-tactic. Keep the stressed parents caffeinated, keep the toddler contained, and mathematically their dwell time in the store increases.
Which naturally expands their basket size.
Exactly.
But, Fidelk also issued a pretty strong caution. He explicitly noted they are, quote, only a quarter into this year. He warned management not to get out over their skis.
Because they're still fighting Walmart.
Right, a bruising ground war with Walmart for dominance in those lower-priced essentials. If structural inflation stays sticky, consumers will eventually abandon the luxury baby concierge and migrate straight to the warehouse clubs.
Which means Target's entire luxury margin strategy only works if they can keep the baseline costs of those essential goods down.
Yep.
And that relies entirely on a functioning international supply chain.
Which brings us to a major development out of Beijing. China just confirmed the purchase of 200 Boeing jets, with a promise of 750 total following a Trump-Xi summit.
The macroeconomic relief here cannot be overstated. The two sides are working toward extending the tariff truce from October 2025 and are seeking tariff cuts on $30 billion or more of goods each.
And this U.S.-China de-escalation is actually the key to understanding the insane volatility we are seeing on the NovaStream crypto charts right now.
Oh, completely. Because this trade truce was one of the primary drivers of risk-on behavior last month, it pushed institutional money into spot Bitcoin ETFs, resulting in $2 billion of net inflows in April.
Massive inflows.
Yeah, BlackRock's IBIT absorbed a ton of that, pushing Bitcoin up 12%.
But the narrative shifted violently in May.
A total bloodbath. Spot Bitcoin ETFs bled nearly $2 billion in mid-May. We saw over $1 billion lost just in the week ending May 15th alone, including a brutal $635 million single-day deficit on May 13th.
Yeah. And if we connect this to the bigger picture, it comes right back to the bond market mechanics we discussed in segment 1.
Okay, tie it together for us.
Well, we received a sticky 3.8% CPI inflation print. When inflation stays hot, the Federal Reserve refuses to cut interest rates.
Right.
When interest rates stay high, newly issued U.S. Treasury bonds pay out higher guaranteed returns. This creates a yield shock. Institutional capital looks at Bitcoin, an asset that yields no interest, and compares it to a U.S. bond offering a guaranteed 5% return.
It's a no-brainer for them.
Yeah, the institutions simply reallocated their capital, they fled risk, and locked in the bond yields. Add in the fact that Bitcoin failed to cleanly break that psychological $80,000 ceiling, and sideline funds just became incredibly cautious.
You know, we actually have a highly relevant viewer question coming through the chat about this exact dynamic.
Oh, let's hear it.
A viewer asks, if this macro environment tips into a full recession, is it better to hold Bitcoin or XRP? And here's where it gets really interesting, because I want to play devil's advocate for a second.
Okay, go for it.
Wouldn't XRP be fundamentally safer because it has actual tangible utility in the banking sector as a bridge currency, whereas Bitcoin is just sitting there on a ledger? Shouldn't functional utility win out when the economy contracts?
It is entirely counterintuitive, but the underlying data suggests the opposite.
Wait, really?
Yeah, that utility is precisely XRP's greatest vulnerability in a downturn.
How so?
Because XRP functions as a bridge currency for international trade and cross-border remittances. A global recession means a steep drop in international trade deals and lower transaction volumes. Therefore, a recession actively destroys the organic demand for the XRP token.
Oh, wow. I didn't think of it that way.
Furthermore, its value is closely tethered to Ripple's corporate infrastructure. If financial institutions pull back on technological onboarding during a recession, the token suffers.
So utility basically becomes a liability when the system you are utilized within begins to shrink?
Precisely. And Bitcoin operates on a completely different structural premise. It has a mathematically fixed supply cap and relies on a decentralized autonomous network.
Right, the digital gold narrative.
Exactly. In a severe recession, when corporate earnings plummet and fiat currencies look fragile, institutions don't buy Bitcoin to facilitate daily trade. They treat it as a mathematically scarce vault. They buy it to preserve value outside the traditional corporate banking system.
That makes total sense. So moving from digital ledgers to the ultimate market mover.
The government.
The gov-
Always comes back to Washington.
Right. Whether we are analyzing inflation metrics, tariffs, or tax policy, Washington dictates the rules of the game. So we are shifting focus to our domestic political ticker. And before we do, I want to explicitly remind everyone listening, NovaStream is simply reporting the raw facts and underlying mechanics of the political tape as they break. We are not endorsing any viewpoint, and we absolutely do not take sides on either the right or the left. We are just here to analyze the data.
And the data from today's gubernatorial primaries reveals some profound shifts in voter behavior. Let's look at Oregon.
Right. So conservative Christine Drazan won the GOP nomination and will face Democratic Governor Tina Kotek. Drazan defeated a 14-candidate field, which actually included former NBA player Chris Dudley.
Yeah, crowded field.
Now, let's contextualize this for a second. Oregon hasn't had a Republican governor since 1982, and the state won for Vice President Harris by 14 points in the 2024 presidential election. But Drazan lost to Kotek by less than 4 points in 2022.
And that 2022 margin is a masterclass in localized politics.
How does a state that leans so heavily left nationally almost elect a Republican governor?
Well, Drazan's strategy was to completely detach from polarizing national narratives and hyper-focus on local municipal pain points, specifically urban crime, homelessness, and localized economic strain.
So making it about the neighborhood, not the nation.
Exactly. Voters in Oregon demonstrated they were willing to split their ticket. Voting blue for federal representation, but considering a conservative approach for state-level administrative issues.
Fascinating. And down in Georgia, we have another major primary result with a completely different mechanical strategy. Keisha Lance Bottoms, the former mayor of Atlanta, won the Democratic primary for governor with over 50% of the vote. She will face Republican Governor Brian Kemp.
And her campaign faced serious internal hurdles. I mean, critics had raised significant doubts about her single-term mayoral record in Atlanta from 4 years ago.
Right, framing it as a period of administrative turmoil.
Yeah.
So how did she overcome that internal skepticism to secure an outright majority in such a crowded primary?
She effectively did the inverse of Drazan in Oregon.
Oh, really?
Yeah, instead of localizing the race, Bottoms nationalized it. She bypassed debates about local city management and leaned heavily into strong name recognition, turning her primary campaign into a unified referendum against President Trump.
Ah, I see.
By aligning herself with the national Democratic resistance, she successfully convinced voters to look past her municipal record and focus on the broader ideological battle.
It is a stark reminder that in modern politics, the scope of the narrative, whether you choose to fight on local administrative grounds or national ideological ones, that often dictates the outcome.
100%.
And speaking of President Trump, our breaking news feed just highlighted a massive resolution regarding his finances. The ongoing lawsuit filed by President Trump and his sons against the IRS has officially ended in a settlement.
This is a huge deal.
Yeah, the agreement effectively frees Trump from a potential $100 million adverse ruling.
And the accounting mechanics behind this dispute are incredibly complex. The audit was tied to a $72.9 million tax refund that Trump received starting in 2010.
Right, and this refund was based on his peak earnings from The Apprentice between 2005 and 2008. So to justify erasing the tax burden on those massive earnings, Trump claimed $1.4 billion in business losses for 2008 and 2009.
A billion point four.
Yeah, and these losses largely stemmed from two major projects: failing casinos and a money-losing condo hotel tower in Chicago.
Right. And in standard accounting, you generally claim a capital loss when you sell an asset for less than you paid for it.
Hmm.
But Trump's team used a highly specialized tax code loophole regarding uh, abandonment and worthlessness.
Worthlessness.
Yeah. He notified the SEC that his partnership interests lacked any potential to regain value, essentially treating a still-standing functioning building as a total loss on paper by claiming the equity position was fundamentally underwater.
Oh.
This precise wording allowed him to unlock losses he had been allowed to use in prior years.
But the IRS stepped in, arguing he tried to claim the massive Chicago losses twice over different filing periods.
And this raises an important question about how settlements function at this tier of wealth. By agreeing to end the lawsuit, the settlement entirely sidesteps judicial review.
Meaning what, exactly?
Meaning a judge never formally rules on whether that worthlessness claim was legally valid in the first place.
Oh, wow. So it just goes away.
Yeah, and more importantly, this agreement puts an end to any other IRS audit pertaining to tax returns the Trumps or their businesses have already filed. It is a sweeping, unquantifiable financial victory that protects the broader Trump organization from retroactive scrutiny.
That's incredible. From billionaires utilizing complex tax code loopholes to everyday households seeking relief, our final item touches on a vital policy shift in the Northeast.
Yeah, let's talk about Connecticut.
Connecticut is passing a state budget that includes a family caregiver tax credit. They are only the third state in the country to implement this.
And it is addressing a severe structural strain in the economy. Healthcare inflation is vastly outpacing wage growth right now.
It's crushing families.
Yeah. Family caregivers face immense financial burdens, and they often suffer permanent career setbacks just to care for aging or ill loved ones.
Well, analysts note this credit only offsets a fraction of the actual financial burden. It is a really critical step.
Because the macroeconomic consequences are severe. When caregivers are forced to drop out of the workforce entirely due to the sheer cost of professional care, it reduces overall labor participation,
Right.
which compounds the strain on the broader economy. So localized tax credits are an attempt to keep those individuals economically active while they shoulder that care burden.
So what does this all mean? We have covered a vast amount of ground today. We started with the global shockwaves in the Strait of Hormuz, observing how the mere statistical probability of diplomatic peace evaporates risk premiums and shifts oil and bond markets.
Yeah.
We saw how those very same inflation fears sparked a sudden $2 billion exodus from Bitcoin ETFs, punishing assets that don't yield interest.
We also examined how the physical economy is adapting, right? With Target deploying brilliant psychological retail strategies right down to the cup holders on their shopping carts to keep squeeze consumer spending.
That still blows my mind.
And finally, we tracked the profound political and tax shifts reshaping the domestic landscape, from the tactical campaign narratives in Oregon and Georgia to the intricacies of IRS settlements.
It's like you pull a thread on energy policy, and it ripples through retail aisles, digital wallets, and state capitals.
It really does. And I want to leave you with a final thought to mull over. We watched institutional money pivot flawlessly from crypto back to bonds at the very first sign of sticky inflation. They possess the agility and the mechanisms to protect their wealth. Meanwhile, everyday consumers and family caregivers are forced to simply absorb those rising costs. It makes you wonder, as retail giants like Target build luxury experiences to mask the sting of inflation, are we successfully masking the actual health of the economy, or are we just changing how we experience the squeeze?
That is an excellent framework to keep in mind as you watch these numbers move. Thank you for joining us for these highlights of the day on NovaStream. Keep your eyes on the live tickers running at the bottom of your screen. The markets never sleep, and neither does the data. We will see you on the next broadcast. Stay informed, and goodbye for now.